Michael Feder, CEO of Radar Logic, and joining us from Seattle is Stan Humphries. He is the chief economist at Zillow as we look ahead to housing in 2011. Michael, let's kick it off with you. Housing, does it get any better? I mean, you've been on with Matt and myself a lot, and you're pretty negative in terms of your outlook.
Well, we are, Carol, and the big problem, of course, as we see it, is the inventory. There's just a huge shadow inventory of homes that either are or may become for sale. There's this massive overhang of heavily discounted inventory from the foreclosure and short sale marketplace, and there's just not enough demand to absorb that inventory and help get this market kicked off. The only people who seem to have gotten it are the builders, and they've stopped building. Stan,
you agree? Are you as negative as Mike is?
I am pretty negative. I mean, in terms of 2011, we're looking for 5 to 7% decline between now and the bottom, which we think will occur late in 2011. And the core principal reasons behind that forecast are exactly as Michael outlined. We see very weak demand because unemployment we expect to stay quite high, above 9%. Through 2011, and supply is just overwhelming. Really, I mean, we are tripping over houses in this country right now.
Well, that brings up a key question, which is where do prices go from here? And I want to start with you because I was told the number one question is price, price, price. And when you say it's inventory, 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 they are related.
Well, they are, Sue, but we've been tracking the market as two different parts now for almost 2 years. We have one group that we call motivated, which are those houses that are for sale in financial distress, and the other group that's called other. What we've seen is a dramatic shift in activity towards the motivated homes. In other words, the ones that the banks are willing to take discounted prices just to get off their books. The difference between the price points, as we calculate them, between those two markets is as high as 40%. So if the activity is moving to the homes that are discounted by 30 to 40%, what does that say for the others? Eventually, the watermark is going to go lower. Stan brought up a very interesting point, actually, talking about the overhang of inventory and the expectation for prices to drop as much as 5 or 7% from here. I think it was CoreLogic that said that we're operating with about 10 million homes, quote, underwater, meaning they're not worth as much as their mortgage, but that if prices fell another 10%, that number would double. To put that into some perspective, we're coming up on that 10% drop, and if that number doubles, it represents almost half of the mortgaged housing stock in this country.
Well, I have to ask the question, if you're on a street and a house of your value is selling at half the value, what's the incentive for that homeowner to continue to pay mortgage?
Well, that's the key question, I think. We don't have good numbers on these strategic defaults, but there's been a lot of discussion in the media and elsewhere about the fact that it's very difficult to get a bank to renegotiate your mortgage if it's not in default. So the concern is, of course, more and more people who are way underwater will simply stop paying their mortgages so they can try to renegotiate.
I mean, Stan, is that what you expect to happen?
Well, I think strategic defaults are a really interesting phenomena, and right now it is hard to get a good bead on how prevalent they are in the mortgage stock right now. I mean, some estimates have put it as low as 12%. More realistic estimates put it as high as 25%. But the reality is you don't really know. I think the alarming thing is that Fannie Mae had recently done some research in the past 6 months that did indicate a homeowner's likelihood of going into strategic default was much higher if they knew someone who did. So there is really a more of an epidemiological aspect to this of almost transmission of a contagion. If rates of strategic defaults do increase, there's some fear in some quarters that there's a tipping point at which it becomes a lot more prevalent, in which case you start to see that rate really escalate, and that's quite damaging, of course, to the mortgage industry.
I mean, it is very damaging. I mean, Michael, is that how you expect it to play out? I mean, that's where we're headed?
Well, I don't know if that's where we're headed, Carol. I mean, I think it's a very difficult decision to default on a loan if you're in a position to carry it.
Right.
I think there's another interesting question here that nobody seems to want to talk about, which is that when you look at call it $2.5 to $3 trillion worth of homes that are in some sort of financial distress or potentially could go into strategic default. The federal government, in the form of the GSEs, Fannie and Freddie, are ultimately the lenders to a vast majority of that. And the thing that is so troubling to me is that we're not hearing about that hit to the budget cycle in this country either. If all of the homes that are unsold and in default and ultimately in the possession of Fannie or Freddie go into default and get sold at auction or other foreclosure prices, that's $1 trillion+ loss to you and me as taxpayers.
I
wanted to point out something Warren Buffett said back in March, which is he was somewhat optimistic for 2011, but said for every lender and seller who loses, there's a buyer who benefits at a lower price. Is there a fallacy to that logic?
Well, you know, I think that's right at sort of margin, but when you look at the size of this asset class in distress, you know, that's a lot of buyers you got to go find.
But isn't there some point, I mean, Stan, isn't there some point where houses do become more affordable? Folks who couldn't afford them are now saying, wow, I can actually go out and buy a house.
Well, that logic that you just articulated from Warren Buffett is exactly the case for first-time home buyers. I mean, for them, these home price declines represent an unprecedented opportunity. I mean, we've got affordability now, which has been recast more than 10 years. We've got house price levels, which are back to late 2003 levels. And combine that with financing, you get affordability, and that's what's now back to late 1990 levels. So affordability for first-time home buyers is fantastic. The trouble is that the overwhelming majority of home buyers also are existing home buyers, so they've got a house they already own.
Right.
So the problem is that they're underwater on their house, makes it hard for them to go out and buy another house, even though it's more affordable, the new house.
You know, Sue mentioned about Warren Buffett because he's pretty upbeat about the housing market, and what I found fascinating is Bill Ackman also made a presentation at the Value Investing Congress back in November. He said how to make a fortune, and he's talking about why it's the right time to invest in real estate. I mean, Stan, does that not make any sense to you at all?
Well, I think it maybe makes. I think if you squint, you can kind of see. I mean, he's not alone. We've got John Paulson out there also making similar, things about if you own a house, go buy another one. If you own two, buy a third. So if you kind of squint, I think I can see where they're coming from there, and what the bet they're making isn't just predicated on home prices. Their bet also includes some expectations about what's going to happen to mortgage rates and also what's going to happen to inflation. So particularly Paulson is looking for, he thinks double-digit inflation is going to hit us, and if you lock in now in real estate with these fantastically low mortgage rates and inflation goes to double digits, he's betting on that just as much as he's betting on the house price increases. But I do think they're overestimating how much home price increases we're going to see over the next couple of years.
You real quickly, jobs, economy, rates, which one weighs the most important in your equation?
I think it's undoubtedly jobs right now. I mean, I think that certainly higher mortgage rates aren't going to help, but really I think that their impact is much more marginal relative to unemployment rate and consumer confidence. I mean, the two reasons people are not buying right now and more often, I think it really has to do with they're worried about jobs, economic insecurity, and they're worried about continuing home price declines, so that keeps them on the fence right now.
You know, Michael, jobs aren't going to get fixed overnight, that's for sure. I mean, it's been a slow move back a little bit. We're seeing a little bit of job creation. The housing market's going to take a while. I mean, do we need to see the administration step in some more? Do they need to force banks to start restructuring some of these mortgages? I mean, what do you think needs to be done here?
Well, you know, Carol, I'm not an economist, and I have a lot of respect for the economists that follow this industry, but to be blunt, I don't think jobs are the issue. I think it's the inventory that's the issue. I think Stan's second point, which is people are afraid that prices are going to fall further, is the issue, and that's all about the inventory. The problem is that the only way we're clearing this inventory now is to foreclose on a home, evict the homeowner, and then put that house back on the market and try to sell it. Well, that's bringing prices down because those sales are happening at 30 to 40% below the standard market.
But then is it just time that we have to wait for that inventory to work its way off? Well,
we did a report, I think you may remember a couple months ago, that suggested if you take all of the outstanding unsold inventory, you start adding in the shadow inventory, the prospect of strategic default inventory, we're talking about a time frame that's not measured in 8 or 9 months, it's measured in 8 or 9 years, and I don't think that's a healthy thing for the economy. No, I think we need to do something very dramatic, and as I've said on this show before, I think the federal government needs to step in and restructure the loans that it's holding to create an alternative equity investment and let the Ackmans and the Paulsons who want to go long housing do so.
Stan, we got 30 seconds left here. What do you want to see either out of the administration, maybe to help out the housing market, or should they be doing nothing?
Well, I think I'm open to these ideas about, as Michael described, about upping of the Fannie Mae guarantee. Also, these efforts to improve the streamlined FHA refinancing. Okay. And I think even more exotic things about shared appreciation mortgages, I think, are attractive as well.
All right, got to leave it on that note, guys. Great discussion. Stan, thank you so much. Stan Humphries of Zillow and also Michael Fetter here in studio, CEO of Radar Logic. Guys, thank you so much. And our own Sue Keenan, who's been tracking the housing industry for us.